Sarah, so I think there's still people joining, so we might give it 2 more minutes before we start.
Perfect, Claire. Yeah, sounds good.
Okay, I think we'll get going, Sarah.
Go ahead there, Claire. Yeah, thanks.
Great. Okay, so good evening, everybody. My name is Claire Hanrahan. I'm the Managing Director at Irish Pensions and Finance. You're very welcome this evening to the last of our spring webinar series for 2023. I believe, Sarah, this is our fourth online for the investment webinar series.
It is indeed, yeah. And then we had, was it 3 or 4 before that in person as well? So yeah.
Yeah. But I think, look, it's this format is brilliant because people from up and down the country are logging in. So it's just more convenient, I suppose, for a lot of people. So I'm really very, very welcome to James Forbes. He's the head of investment solutions at Goodbody Asset Management. So thanks, James, for giving us your time this evening. James, you usually deal with financial advisors directly. But I think it's a great opportunity for customers of Irish Pensions and Finance to get your insight and knowledge. And I think what we found over the years is that, James, you explain things very easily in layman's terms. You know, sometimes people can be very intimidated and the topic, they could see it as complex, but it's about making it really understandable, I suppose.
I think that's a key point, Claire. You know, we in the finance industry love to create lots of complexity. We think the more complex we make it, maybe the more challenging it is. But, you know, we're a firm believer in trying to keep things as straightforward as possible. Great.
So thanks very much. And then John Kennedy is with us as well. So John is one of our senior financial planners here at Irish Pensions and Finance. You've over 8 years experience in financial advice. And I know that this is an area you really love helping your clients with, John.
Yeah, it is, Claire. I think it's just one of those sometimes taboo topics where people get very intimidated when they hear investments. And as James says, it can be over complicated at times. So it is a lot more straightforward than it is. And it's so important to be a part of your overall financial goals is the investment side of things. So yeah, it is something that's very important that a lot of my clients will hopefully find beneficial today, especially.
Great. As always, Sarah, our head of marketing and our producer for this evening. So none of this ever happens without Sarah. So thank you as always. Never take you for granted.
Thanks, Claire. And thanks to the 3 of you guys for giving us your knowledge tonight. Thank you.
Great. Okay. Now, before we get going, just a couple of rules of engagement of the night. I think we estimate that it should take about 45 minutes to an hour for the slides. Now, we nearly 500 RSVPs, absolutely brilliant. And people have submitted questions beforehand that they would like us to cover. Now, having looked through the seminar, I think we cover a lot of the questions. What we're going to do is we're going to keep the chat function closed while the presenters are going through the slides. But what we will do is we'll open up, if we have time, the chat function at the end for maybe 5 to 10 minutes for some questions. If we don't get to the question, John is going to explain next steps for actually sitting down with an advisor. So at that stage, we can cover the question with you. To keep it interesting, making sure you're keeping you on your toes. We have €100 all for one voucher available. So we're going to ask a question at the end of the seminar. And the first person, we're going to open up the chat function. The first person to get the question correct will get an all for one voucher for €100. So now, as I said, we've nearly 500 people RSVP'd. Typically, when we started doing these seminars, they were aimed at people who've retired, who were now in possession of a gratuity, a big pot of money that, you know, they've maybe never had in their lifetime, and how can they use it? But I was actually blown away when I saw the demographics of people joining on the call this evening. The youngest person that was jumping on is 24, right up until the mid-70s. Would that surprise you, James, to hear that? Or is that something we're seeing a little bit more in the industry?
I think, you know, I'd be surprised that the younger people are engaged, which is brilliant to see, because it's just so important to, you know, start your journey, your investment journey at as early a stage as possible. And, you know, it's something. I've got kids now that are working part-time and etc. And, you know, I sort of try to say to them, you know, just think about it. And there is pension options actually available. My eldest works in a hospital part-time, and I'm saying to her, just, yeah, definitely take the pension, invest in the pension. It's not going to go wrong. You've got 40 years to worry about it. So you'll be absolutely fine. So I think it's great when younger people are more engaged. And I think, generally in social media today, we see a lot more, whether it's TikTokers talking about investments and different things that are happening. I think people are quite clued in and they are looking for solutions, for their money.
Yeah, brilliant. And we're going to go into that this evening. And look, we have, majority of our people attending this evening are from public sector up and down the country, but we do have some private sector people in here as well. So will we get going? We're going to move on to the first slide. So yeah, look, Irish Pensions and Finance, who are we? So we were established in 1993. We've over 25,000 policyholders with more than 32,000 policies. We're really proud that we've over 4,000 retired clients. That's, really proud number for us that we've helped them through that journey. We've over 700 million in funds under management. So we're an authorised advisor. So what that means is as Irish Pensions and Finance, we're an independent brokers. We're not tied to any one company. I suppose, James, where does somewhere like Goodbody come into the mix for the customers?
Claire, that's a great question, because I often get asked it when I'm doing webinars like this. And I suppose the key point is that all that we do in Goodbody is just manage funds. We manage it on behalf of financial advisors, the likes of IPF. So, what we do is we work with you as the financial advisor and your clients to try and find a solution for your clients' financial needs. So that's really where Goodbody fits in. As I said, we're just a provider of a number of funds that IPF can access.
Great. That's perfect. Within IPF, we've 42 financial planners, and we've an experienced back office of 22 staff. So yeah, we're really proud of the company we have here, and we love helping our clients. So we move on to the next slide. So John, I'm going to bring you in here. Talk us through this slide. What does this mean for the people on the call this evening?
Yeah, thanks, Claire. So I suppose, first of all, it's great to see so many people tuning in today. I think it's a real sign of the times, and we hear a lot about what you see on your screen at the moment, like deposit rates and sort of the threat of inflation. The cost of living has been a huge one over the last, I suppose, number of years. We will see fuel prices go up, and essentially everything around us is getting more expensive. So I suppose what we'd like to do today is give you guys an idea of why people invest. Okay, so what kind of things or what type of money you should be investing. And then secondly, we're going to go through some options. So if I need to invest, what can I invest in? All right. But one of the most important things that I would do when we sit down with our clients is the very first thing is decide, when do you plan on spending your money? Because time is so important when you talk about this kind of stuff. Okay. So when we sit down with clients, we have a look at what your short-term needs are, what your medium-term needs are, and what your long-term needs are. And what I mean by this, right, is short-term is any money you'd need within the next 5 years. So what you plan on using your money for. Okay. And that money is very well suited for, say, the bank or the credit union, because you're going to spend it in the next 5 years. And the threat of inflation doesn't necessarily affect it too much, all right? But what we're really going to focus on today is more your medium and long-term goals. So say money you'll need in 5 years' time, or maybe it's pension money you need in 10 plus years' time. So that's really what we're going to focus on, because that's when inflation and the cost of living increases can have a huge effect on your money. Because these factors, or these things you see on your screen, they're outside of our control. We can't control the cost of living. But it also has a real effect on your money when you look at it over the long term.
Great.
Okay. I don't know if anybody follows us on Instagram at the moment, but we shared an article from the Irish Times. It's a very interesting one, and our marketing team do a very good job of sharing some of this information for our clients. So if you are interested in keeping up to date with this kind of stuff on a more regular basis, you can follow us and get those articles. But the Irish Times basically said that if you have cash on deposit, you are losing money, and not just by a bit, by a lot. So what today is about is giving you an understanding as to why this is the case, and then more importantly, what can you do about it? Okay, yeah. So that's also very, very important. And I think, to go back to what James was, this kind of area can often be overcomplicated, because when we think about investing, I suppose naturally you think about Do I have to invest in a company stock, or do I pick Google over Microsoft, and so on and so on? And it's a different area in a different world. There's company bonds out there that you can invest in. There's government bonds, there's a property, there's gold, and there's so many options out there for clients. But what we don't often know is that insurance companies do a lot of this work for us, okay? And what I mean by that is the likes of Goodbodies, or say a Zurich of this world, or Aviva, or New Ireland, or Irish Life, they create what's called multi-asset funds. And what I mean by multi-asset funds is they invest in a wide range of areas. So your stocks and your shares, your bonds, and they basically invest in a lot of these different assets to spread the risk of your investment. So what we're going to do today, or I suppose what our job as advisors in IPF is, we have a look at all the different funds that are on the market with the different insurance companies. And we will see which ones are better than the others, which ones are doing what they should be doing, and which ones are appropriate for our clients. And then we're able to make a recommendation as to what will suit our clients and what their goals are. Okay.
Yeah, I have a question in here, John, from Grania in the HSC. So she was just wondering, like, where and how to start. Like, you know, like, it's a bit of a minefield.
Yes, no, absolutely. It is a minefield. And I suppose the very first thing I'd be recommending to Grania is to engage with a financial advisor, okay? And see, what a financial advisor will do is the very first thing, and if you sit down with us, we'd be going through a fact-finding process. And what that means, Grania, is we'd sit down with you and we'd have a look at what you already have financially at the moment. It's very important we know this. So first of all, to give advice based on your circumstances, and secondly, to make sure we're not giving you any wrong advice. Okay, so that's the first part of the consultation process. But once we have that done, Grania, we'd be having a look at what your goals are. So what you'd like to see happen in, say, the next 5 years, or then 5 years plus, and so on. And once we have an idea of where we are at the moment and where you'd like to go, then we'd have a chat around what your attitude to risk would be.
Yeah. So I suppose for the person sitting at home, what does that even mean?
Yeah, it's a really, really good question. And see, these multi-asset funds, they're actually rated from a 1 to a 7. So it's a European rating. And it's basically to make it easier for, I suppose, somebody who doesn't look at this on a regular basis to understand how much risk they're taking when they do put their money into one of these funds. So each of these funds should have a number beside it, and it should be rated from a 1 to a 7. So 1 is your very low risk, and 7 is your very high risk. And there's a load of different funds in between. Okay. Right. So that's what we mean by looking at what type of investor you are and how much risk you take. Okay.
And John, it's probably fair to say that many clients would typically fall into the 3 or 4 category. Is that a fair reflection?
Absolutely. Absolutely. I think the Irish are very middle of the line type of people. So most people, we'll actually send out a risk questionnaire, and you ask a couple of questions, and it will give us the number as to what type of investor you are between 1 and 7. And as you say, James, most people come within the 3 and the 4 category. Okay, the odd 5 and the odd 2. But then just to go back to Grania's question, if we'll make a recommendation based on your goals and your situation, and then if you're happy with that recommendation, we go ahead and make an application and set up the plan for you. And then the very last point here, which is probably one of the most important points, because I know we have a lot of clients or existing clients on the call at the moment, is the regular reviews that we do. Mm-hmm. So it's not a policy you'd set up and then forget about. It's a policy you set up, and then we would sit down with you at least once a year to review your plan, to go over your goals again, to make sure that if anything has changed in your lives and your goals have changed, that we're able to tweak them along the way, because these plans can be quite flexible in that regard. Okay, so you might have certain goals now, they might change in a couple of years, they likely will. So it's important that we go through those regular reviews as well.
Brilliant. Okay, well, that's great. Thanks, John. I know we're going to come back to you again at the end on, a few more bits of information about next steps and just to kind of revisit that consultation process.
Okay.
Great. James, so a lot has changed since our last seminar. The world has changed.
Yes, Claire, the world has changed dramatically. If this time last year, we were sitting and we were talking about the central banks all around the world saying, don't worry about inflation. It's not a major problem. It's transitory, this famous word, which meant that they were expecting it to come down quite quickly. And it was just about this time last year that the central bankers around the world finally started to admit that they got it wrong, that the inflation genie that was in the bottle has got out and they've got to deal with it. So, question, and I've been traveling around the country extensively over the last 6 weeks, all the way from Donegal and Cork and Kerry and Kilkenny and everywhere else in between. The question I typically get is, what do you do with your money in an inflationary environment? And that's what I've got a couple of slides this evening, Claire, trying to cover off, where people might consider some options for their money over the medium term. As John was saying, if you're thinking about investing, think about it over the medium term, typically a 5 to 7 year period.
Great. Okay.
So I suppose, kicking off, we'll talk a little bit about why invest. We might look at some of the options that are available to retail investors, in the Irish market in particular. And maybe more specifically, we'll talk about some solutions, but much more importantly, what might be the next steps for you on this webinar this evening. But I suppose before we get started on a lot of these topics this evening, as any of us pick up the newspapers in the morning or switch on the radio, we get the headlines, the global headlines, the financial news. And there's no doubt about it, when we look at the financial news over the last 6 to 9 months, it's really been dominated by a couple of key themes. And I suppose the one here on the right-hand side, has taken up an awful lot of space, and rightly so. The invasion of Ukraine by Russia has caused massive problems at a human level. It's also had repercussions for the rest of the world in terms of items like food supply and energy security. And that has fed on into some of the movements by the central banks and what they've been doing over the last 12 months. And they've actually been very active. They've been more active over the last 12 months than they have been over the last 10 years.
Oh, wow, that's interesting. Didn't realize that. Yeah. Yeah,
it's been incredibly, they've been very slow to move over 10 years. And then suddenly, when they get into action, they've actually put themselves into gear and started making a lot of moves on interest rates. But I think, the key thing that everybody in the investment world is really focused in on is inflation. And what we saw last year in 2022 was massive increases in inflation and the impact of inflation. And I suppose what people are trying to work out now is, how quickly will inflation come down? And it's starting to come down, which is the good news. The question is, how quickly might it come down? I must confess, I liken inflation a little bit to me trying to lose weight after Christmas. If I'm trying to lose a stone after Christmas, to lose the first 5 or 6 pounds, that's easy. But to lose the last bit, that's the hard part. And I think it's going to be the same with inflation. Inflation, can increase, and we currently have inflation in Ireland at 7%. To get it back down to 2%, it'll be easier to get it down to 4%, but to get from 4 down to 2, that's going to be the challenge.
Okay.
So I suppose maybe as we kick off here this evening, we're talking about investments. I suppose one of the first places that many of us look to when we want to invest our money or put our money away historically has been the banks or credit unions, and that's where we've typically saved.
Yeah, because I think a lot of the attendees, James, like their question is, look, I have money on deposit in the bank. What should I do with it? That's
a great question, Claire, because when this next chart just looks at what the bank deposit rates have been in Ireland over the last 12 years or so. So at the times of the financial crisis, whenever a lot of problems in the banking sector, the banks were anxious to get deposits over the door. So they were prepared to pay up for your money. So back in 2010, the deposit rate typically in Ireland at that stage was 5.5%. And even after the financial crisis in 2014, if you put your money in a bank deposit, on let's say a 6-month notice period, you'd have got about 2%. But what you can see by 2022, last year, the interest rate had fallen to virtually 0. Now, what we have seen more recently is that it's ticked up slightly. So in the last month or two, typically what you'll get is about 0.5 of 1% on a deposit for 1 year. So it's still not a great return for anybody that's looking for a decent return on their money.
Yeah, okay.
And I suppose, initially when we look at this chart and we look at 2010 to 2022, and we would have had investors and they'd say, well, why did Irish bank deposit rates come down? It was actually quite simple. It was because what was happening in the ECB. So the European Central Bank set the interest rate, and the European Central Bank set it very low because it was worried about growth. It wanted to create more growth. And in fact, the European Central Bank set interest rates at a negative territory. So it was a very, very unusual situation. But if we look at what's happened, and certainly over the last 9 months or so, I've got a few letters in the door informing me that my mortgage has increased.
Yeah, every letter from the bank is like it's going up again.
It's going up again. And if you look at this chart, you can see what's happened to the European Central Bank rate since July of last year. It's gone from minus 50 basis points up to 3%. So from minus 0.5 to 3, a massive increase in the rate of interest that the European Central Bank is charging. And I suppose on the back of that, what you would expect is that the banks would reflect this increase in their deposit rates that they're offering you and I. But I've just put in.
So they're charging more for the mortgages, but they should give us some more on our savings.
Exactly. But what you can see here, in terms of what they're giving us now, is still a lot less than what they can get from the European Central Bank. So we haven't benefited.
I ask James, why is that? Is it that they don't need the money? Is that what it is? Or?
That's exactly it, Claire. The two major Irish banks, Bank of Ireland and AIB, are very strong at the moment, and they have an awful lot of deposit monies that is sitting with them. That's from people like you and me that are sitting there with them, and they don't need the money. They're not lending out as much on the other side. So they don't need the money. They don't have to pay up for the money. It's only if you and I were to take our money out, they might say, well, you know what, we need to have more deposits in our bank. We'll have to pay a better rate of interest to get those deposits. And Claire, that's part of what was happening. You may have read a little bit about what was happening to Silicon Valley Bank about a month ago.
Yeah.
There was a bank that once again didn't pay up what was a market rate for their deposits. And suddenly depositors woke up to this and they said, well, I'm going to take my money out. And then more took their money out. And as more and more people took their money out, there was a bit of a run on the bank and it eventually had to be sold. So it's the situation at the moment is that the banks aren't paying up enough in order to what they could be paying. They want to hold it on to themselves. But if they're making loans, they're quite happy to charge us extra on our loans on the other side.
Yeah. And I think though, like in principle, does that really matter? Like, does it matter that I'm not getting too much in the bank?
It has quite a dramatic impact at the moment, Claire, because of what's happening with regards inflation. And inflation has had a massive impact on our everyday cost of goods and services. So if you think about it, if we're getting a very low rate of return from our deposits in the bank, from our savings in the bank, it's not covering for the increased costs that we're having to pay for our goods and services.
Okay.
And that's the important thing, because we used to call, over the last 15 years, we used to call inflation the silent thief. Companies would have increased prices maybe 2 or 3% per annum, but they're not doing that anymore. What we've seen now is that there've been massive increases. And this is just a headline from the Irish Times taken back in January. And it's just saying that supermarket prices in the year to the end of January went up 15.4%. That's massive for the ordinary household. It's a massive increase in your shopping trolley costs.
You definitely notice it.
Definitely. And it went up even further in February. It actually went up to 16%. So what we're seeing is massive increases that are starting to come through. But it's not just here in Ireland. We're seeing it throughout the world and in the Eurozone as well. So we have the European Central Bank, and the lady in the picture there is Christine Lagarde. She's the president of the ECB, and she's continuing to warn us that inflation is still too high. So what we are starting to see in Europe at the moment is that energy prices have come down compared to last year. So ultimately, you and I will see a decline in terms of our electricity prices. It may take a while to happen, but we are seeing, more importantly, things like the price of petrol and diesel have come down, quite reasonably over the last number of months. But what they are seeing is that the prices of goods are still continuing to rise. The price of foods are still continuing to rise. And Christine Lagarde has said, we've got a situation here where inflation is too high. We have to get inflation from 7% back down to 2%. And the only way to continue to do that is to increase interest rates. And that's the increased cost that you and I will pay in our mortgages. So the ECB are going to be, they've moved up to that 3%. They have a meeting typically every 6 weeks. So there's another one in May. There'll actually be one in June, and there'll be one at the end of July. And what we think is that they're going to increase interest rates at each of those meetings. So
possibly another three
possibly another 3 increases by the time we get to the end of the summer. So that's what we're looking at the moment in terms of interest rates, and all of it is to do because of what's happening with inflation. They're determined to stamp it out. They need to get it down to 2%.
Okay.
And I suppose, Claire, when we look at some of the costs, I mean, in our everyday goods, what we can see is quite an increase. And this was a basket that was pulled together from the CSO and some of the year-on-year price increases. And, if you look on average, typically some of the goods are up around about 14%. Price of eggs, a box of 6 eggs up 22%.
Yeah.
And the price of a litre of milk up over 30% year on year. So it's quite a significant increase.
Yeah.
So if you're thinking about some of these goods and every family's using these goods, you think about our breakfast, there is actually a basket pulled together of the cost of a breakfast. And this is the cost of a breakfast over the last 3 or 4 years. Now, when they say a cost of a breakfast, they're including, a whole loaf of bread, 2 litres of milk, 6 eggs. So it's a fairly large family. Don't get me wrong. It's not a cost of a breakfast roll every morning.
Breakfast roll, yeah.
No, but what they are measuring for a larger, medium-sized family, the cost of a breakfast has gone up from about €30.50 up to 34. So an increase there of almost 13% over the last year. So quite significant.
And I'm sure, like, look, this is not news to people on the call this evening. They are feeling it,
Absolutely, Claire. That's the key thing. I think we all know about this, but I think one of the key things that we have to factor in is that because the price of many of our goods and services that we have to pay for it, I mean, we can't live without them. These prices are going to continue to go up over the next couple of years. If we've got money sitting in the bank and it's not earning a decent return for us, well, then it's actually declining in value. And as John was saying earlier on with regards to that article in the Irish Times, basically money in the bank is actually costing you money. And I've got a couple of slides here just to demonstrate, the impact of it. So, if you think of maybe if you had 50,000 in savings today, and let's just say you took your 50,000 and you just put it away. You weren't looking for a return on it. You've just put your 50,000 away.
And I think like looking at the people that are here this evening, like a lot of them, very sensibly, James, they're putting money away for their kids' education. And this is maybe what they'd have,
Yeah, Claire, exactly. People are thinking about, well, my kids' education in the next 10 years' time is going to cost me 50,000. I'll put that money in the bank. So you're getting virtually no return in the bank. But the situation is the cost of education is going to continue to rise. So if the education costs rose by 3%, say, Claire, for each year, modest enough, 3%, the real value of your money after 10 years would fall from 50,000 down to about 36%, or 36,000. So you can see a massive decline. Now, that's just assuming a 3% inflation.
And you said we're at 7 at the minute.
Correct. So, I mean, if you look at the right-hand side of this chart, I've assumed a 7% inflation rate over the next 10 years. So the 50,000 would actually drop down to 24,000 in today's terms. So that's how much inflation would eat into it. Now, I do think inflation will come down. I know the government, etc., has forecast over the next couple of years, it'll be 4 to 5%. But even if we look at inflation at 5% for 10 years, effectively what you're losing is about 2,000 each year in your spending money. And that's
if you said that you're losing 2,000 a year on your money, like, it's scandalous.
Absolutely, because of inflation. And, as John was saying, inflation is largely out of you and I control. So we can't control the rate of inflation of what companies are going to charge us for their products or their services. So what we've got to do is take control ourselves, and decide how can we try and insulate ourselves against the impact of inflation.
Okay. Okay.
So I suppose, we often think about what investments can we make, and there's no doubt about it. There's a wide variety of investments that, many people can make, and what we typically do is bundle them into asset classes. So if you think of some of the major asset classes that typically people might invest in, there's a list of them here on the chart. And, and we talked earlier about cash deposits, just putting your money in a bank or with a credit union, albeit you mightn't get much of a return. You might also invest in government bonds. Now, for instance, you could invest in an Irish government bond. So you could lend the Irish government, let's say €1,000 for 10 years, and you get nearly 3% each year if you lend by buying a bond. So you get a much better return than in a bank. You might also invest in corporate bonds. What are corporate bonds? They're effectively companies issue loans. So if you think of a large company, maybe the likes of a CRH or a BMW, for instance, BMW wants to build a new factory. It issues these loans in the form of bonds. So retail investors can buy them. So you buy a BMW bond and they'll pay you a rate of return each year for, say, 5 or 10 years. You could invest in property, whether it's commercial property or you might have residential property. You might look at things like commodities. So commodity market, it's often dominated by energy. You might think of things like the oil you might want to invest in. You might also invest in some soft commodities like sugar or coffee. Or you might also consider investing in equities. And as John was saying earlier, there's a wide range of equities. And I suppose closer to home, the equities that typically people are looking to invest in are companies like CRH and Ryanair. But I suppose with all of these things, what you see is a situation, some of these investment options have lower risk, some are higher risk. And when we talk about risk, we mean how much do they move around? Do they change a lot? Does the price go up or down a lot? So, but typically what you find, investments that have lower risk typically have lower returns. And if people can accept a little bit of higher risk, you typically get a higher return. And that's the challenge.
I think what you just said in the previous slides is, now where we are at the minute, a low risk fund may not beat inflation.
That's the challenge that many people have, in terms of looking at their money. And I suppose it's a critical thing. And I think it comes back to John's point at the very beginning about, sitting down with an advisor and maybe thinking about, in money that you may have to invest, and maybe think about money and put it into different buckets, Claire. Maybe you might have something, you're going to need your emergency fund that you might need, 6 months of cash to live on. You'd have a medium fund that you may have certain things that you're looking at. You might have, things coming down the road in terms of education that you have to pay. And then you've got a longer term fund. And really what you want to be doing, each of those funds, those buckets that you may have can have different risk profiles, but it's important to look at it in its totality to ensure that you're taking adequate risk to get an adequate return.
So I think the good news is, though, you don't have to do one or the other. You can kind of mix and match. And
that's exactly it. And I think what, we often find is that, what people see is that there's lots of ways to manage it. And I suppose what we try and do is take a lot of these investment options and we look at it a little bit like a jigsaw. So, we've got all these different components, and what we try and do is put them together within one fund, and different components will react in different market conditions. So what you're hoping for is that, if one part goes down, another part of the fund will actually go up and compensate, but over time, the value of the fund should go up. So what you try to do is to build these components into a jigsaw that suits your risk profile.
Very good. Okay.
And James, if you don't mind, what I think is very beneficial for clients as well is that when you take this type of approach for your investing, you're not relying on one company like CRH to do well to make you money. You're not relying on a Ryanair because you're spreading your assets across a lot of different areas. So if those companies go through some hard times, that's when you see quite a drop. But if you're spreading your risk like this approach, it means that you get a much smoother investment, I suppose, return. So it's an important one.
Absolutely, John. That's it. You could look at certain companies do particularly well in different conditions, and others don't. So you don't want to be putting all your eggs in one basket. So you don't want to be buying a load of airlines and the price of fuel goes shooting high. The price of airlines will go down. What you want to do is have a diversification. You want different companies to benefit if the price of oil goes up, etc. So what you want is a broad spread of companies, but good quality companies that you can sleep easy at night knowing that you own.
Great.
So I suppose, when we talk, and John was mentioning earlier on about the multi-asset funds, and, we think of multi-asset funds and putting some of these building blocks together. We think of it in quite straightforward terms. And, within the Goodbody range, we've got 2 multi-asset funds, and we look at it in 2 parts effectively. So we look at, if you're going to get a return, where are you going to get the return from? What's the engine of growth? And we always look at it that the engine of growth that you can get is ultimately from dividend paying equities, or companies as we prefer to call them. So we're investing in companies. So over a 3, 5, 7 year period, typically these dividend paying companies will give decent returns. And then the other part of the multi-asset fund is we think of it as diversifiers. So we know that the engine of growth can be volatile from time to time, but when it's volatile, we want these other assets to actually step in and for them to reduce the volatility and to stabilize it. So we invest in safer assets like government bonds, corporate bonds. We've got cash. We've even got some gold in there. And REITs are actually property companies. So what we're trying to do is just balance it out for investors over the 3 to 5 year period in terms of where they might get their returns.
Okay.
And just to give a little bit more color about the 2 multi-asset funds, as John was saying at the beginning, there's different risk ratings going from 1 to 7. So 3 is one of the most popular ones. So we've got a fund called Goodbody Dividend Income 3. And this just shows the mix of the assets within this fund at the end of March of this year. So currently what we have in the fund is about 36% of the fund invested in global dividend paying companies or equities. We have about 27% in European government bonds. So these are very high quality government bonds, German bonds, French bonds, Dutch bonds, Irish bonds. We've got about 21% in cash. But we've also got our second fund, which moves up the risk category slightly in Goodbody Dividend Income 4. And what you'll see there, the major difference between the 2 funds is that the second fund has a little bit more allocation into these dividend paying equities, 61%. You see that it has less cash and it's also got less government bonds. So this fund is for, will in theory over the medium term should produce higher returns than the first fund. And that's the way that we do it. We look to invest in these assets. And, I think one of the key things for many investors, we'd often say, try to understand what you're invested in, because markets will be volatile. There's no point saying they won't be. They always are volatile. There's always going to be a negative news headline. There's always going to be something happening. But if you know what you're invested in, you're more likely to stay invested. So you'll see in these charts here, we've got equity mentioned. I mentioned that as dividend paying companies. Yeah. But what do I mean? Well, let me give you an example. Instead of owning 1,600 companies, which is in the whole index, we own 35. And here's a sample of some of the 35 companies that we own. And I think, many on the call tonight will recognize very many of the names, whether it's Microsoft, which is currently up about 8% today, L'Oreal, Johnson & Johnson, Abbott Laboratories, Motorola Solutions. These are all names that many people know. So even if a headline came out about markets overnight, something happened in China, would you sleep easy knowing that Microsoft are still going to be there in the morning, that you're still going to pay your Microsoft fees at the end of the month? Of course you will. Would you know that L'Oreal is still going to be there? L'Oreal's been around for 110 years. Right. It's a company which has been owned by a family. They take long-term decisions. They're not taking a decision to manage their business in the next quarter. They're thinking in the next decade, what are they going to be doing and how are they going to do it? But I think
James, sorry, if you wouldn't mind explaining the criteria of company you're looking for, and I suppose the disciplined approach that you'd use when you are choosing these companies, because I think that's a really important point as well.
Yeah, John. I mean, it can be very, very. There's as I mentioned, John, earlier on, there's about 1,600 companies in the world market index that you could invest in. So starting with the largest companies, the likes of your Amazons and Microsoft and Tesla, all of these companies. So there's 1,600 companies and we're an investor and we've got to make a decision which companies do we invest in. So we have to be very disciplined in the types of companies that we like. So the first thing we say is that we will never invest in a company that doesn't make a profit. If you don't make a profit, we have no interest in you. But then we set certain criteria for other companies that we might invest in. So we're looking for companies with very high margins. If you've got good margins, that protects you in case your suppliers increase their costs. You can pass it on to your end consumers. So it's very important, particularly in these inflationary times. So we're looking for companies that have good margins. And typically companies with good margins have good returns on, have good, strong cash flows, because at the end of the day, it's generating cash. And if you generate your profits and you create cash, you can reinvest that cash in your business and you can expand even further. So your profits can continue to grow over the medium term. But the other thing that we think is incredibly important is companies that have good balance sheets. And by that, we mean companies that don't have too much debt, because those are the sorts of companies that can generally do very well in all market conditions. So, if we were to see a recession come along, these companies don't need to worry too much about their financing. They know they've got their own money, they can survive it, they can take opportunities to buy competitors because they've got cash in the bank. So what we like to see is companies that have strong balance sheets. And I often say, John, when I'm looking at these companies, I call them the sleep easy at night. I know share prices are going to go up a little bit, they'll go down a little bit. That's what happens every day. That's what happens in the market. But I know that going to bed every night, these companies are incredibly well run. They're generating great margins, which create good profits. They've got strong cash earnings and they've got good balance sheets. And those are the sorts of companies that tick a lot of boxes for us.
Right.
So maybe just looking briefly, over the last 5 years at, how have things been going? And, in this chart here, really what we're showing is, what has been happening, in world equity markets. And I suppose if you think the blue line is the world equity index. And over the last 5 years, up until the end of last year, that world equity index was up 64%. So a massive increase in the world equity index, up 64%. And if you think about it, we've gone through situations like COVID, whenever the world virtually shut down. We've gone through the situation in Russia, Ukraine. We've gone through the last situation in the last 12 months where massive inflation, the highest inflation we've had in 40 years. So we've had a lot of bad headlines over the last 5 years, yet the world equity index has gone up 64%. And if you look at the yellow line on that chart, it's the Goodbody Dividend Income 4 fund. So it's the fund that typically has about 60% in these dividend paying companies. And it's managed to return 51% over that period. So it's not expected to keep up with the World Equity Index because it's not all equities, but a situation whereby it manages its mix to take advantage of market conditions. And then finally, if you invested money in cash over that period, you actually would have lost money. So you have a situation over 5 years, if you didn't do something with your cash, it would actually have lost you money and lost you money in real terms because of inflation. So I think it's very important for anyone on the call this evening to think about where they would like to have their money on a medium term. But I think one of the other critical things, what we try and do is to manage the journey for investors. And I think, that's really shown here back whenever COVID happened. And I don't think anybody forecast that we were going to have a situation like COVID.
No.
And suddenly the world shut down in a matter of weeks, virtually shut down. And at the very beginning, we didn't know what was going to happen. If you think back to it, we didn't know if a vaccine could be created. When would a vaccine be created? We had a situation where the world equity market, the blue line, fell by about 40%. But because we had a mix of different assets in there, our fund went down by about 15%. So what we had a situation is we didn't go down as much as the world equity index, which meant we didn't have to rise as much whenever to get back up again. And that's very important, when you're looking at any sort of investment, is to see that you're managing the risk within that investment.
Very good. And I think going back to, the risk profile that the client does, if there's 15 questions, it takes about 10 minutes, but it examines things like your aptitude for drops and your, appetite for risk and stuff like that. And like someone in a 4, mightn't be able to tolerate or, stomach, as you say, James, a big drop.
Yeah, Claire, exactly. I mean, the last thing we want to have is investors in a fund and they're worried about their money going to bed every night. And I think that that's the sort of thing that if it is worrying you, it's not for you. And I make that point very clearly. But I think, what we would like to try and do is to, give as much information about what we're investing in so that when people do see prices moving around, as they will, that they know that, what, that's only a price move. I'm not worried about this company will be fine. It's going to be there in 5 years' time. It's going to make a lot of money in that period and the share price is going to recover. And that's why we like to try and provide investors with as much information as possible.
Great.
I suppose, Claire, one of the other things I just mentioned about, investing for the long term, and this is just a chart over 5 years, but, if you look at over, the last, say, 20 odd years, as investors, we've gone through an awful lot in the last 20 odd years. We kicked off this century with the dot-com bubble and all these companies that were never making money, but suddenly crashed, and we had massive crashes. We had the Gulf War in there. Of course, we all remember the financial crisis when, we had the likes of Bear Stearns going to the wall. We had Northern Rock in the UK going to the wall. We had Anglo-Irish Bank going to the wall. We're still paying for that. And, so we've had lots of crises all the way more recently to COVID. But generally what you do see is that equity markets and investments over time generally trend upwards. But the key thing is to stay invested. It's not to get out at the wrong time. So for instance, if you got out, whenever COVID was at its worst, you would have missed the more recent rally over the last 2 years. So the most important thing is that when you make an investment is actually to stay invested with it. And make sure
I remember back at the financial crisis, James, that, like clients, would ring up and say, like, just move me into cash, or, and like you're saying, you're going to crystallize your loss. You're going to lock it in. So it's really staying the journey, isn't it?
It's absolutely, Claire. It's staying the journey, and it's sitting down with your financial advisor and having a good financial plan and understanding what that plan aims to do at a period in the future. And not to get too worried over 1 or 2 or 3 quarters, because it will get back on track unless you decide your financial circumstances change. But it's really to stick with the plan, because if you do stick with the plan, you can put the odds massively in your favor. And I just want to show you a chart. This next chart, I took it from the US, and it shows time is your friend. And I just want to explain it here. So basically, what Bank of America did is they went back and they looked at the S&P 500, the US stock market, and they looked at it every day going back to 1929. So we've nearly got the best part of 100 years there. And what they looked at is every single day of the stock market, if you decided, let's say on the very left-hand side, to take all your money and invest for just one day. So you bought the stock market at the morning when it opened and you sold it that afternoon when it closed, you had a 46% chance of losing money, or you had a 54%.
Like going to Paddy Power, basically.
Basically like Paddy Power. You're basically flicking a coin if you're investing for one day. Now, if you look at the middle of that chart and you decided to invest for 1 year, so that's any 1 year. Let's say, the 24th of April, 1984 to the 24th of April, 1985. You have a 25% chance of losing money, which means you have a 75% chance of making money. But if you can stay invested for 10 years, you have a 90% probability of making money. And these are historical facts. So effectively, over the medium to long term, the odds are massively in your favor if you stay invested. So I think it's very important, for anyone on the call tonight, if you're thinking of making investments, think of your time frame.
Brilliant.
So look, I'm just going to finish up fairly quickly, but, in terms of the next steps, I do think it's very important, at the end of the day, financial advice and the investments that are going to be made are all about you as an investor. So it's very important that, you talk about you, because your appetite for risk and what returns that you require are unique to your particular circumstances. So you need to understand what your investments are. But one of the ways that you can reduce your risk is to understand what the investments are, because if you know what you're invested in, you're less likely to do something that could be adversely impacted. Like, as you were mentioning, Claire, when people were in the middle of the financial crisis, they were just saying, sell everything, put me into cash. And that, you know, I was talking to one of the senior advisors in New Ireland, and he said the largest amount of requests to go into the cash fund in New Ireland happened in March 2009.
Remember the phone ringing.
Yep, that was the very bottom of the market. So people moved into cash at the very wrong time. So I think the important thing is to know what you're invested in, but also to stick to your plan, because that's ultimately where you can deliver your returns.
Right. That's brilliant. So I think, James, if you don't mind hanging on, because I'd say we might open the chat function for a few questions, but we're going to go back over to John.
Yeah, thanks very much, James. So I suppose where we're at now, right, is you probably have a lot of questions, and more importantly, you're probably thinking about your own circumstances. So between now and if you want to organize a consultation with one of our advisors, the things to really be asking yourself are, first of all, how much do I have sitting there? And go back again to your short or medium, your long-term goals, and have a real think about what money you do need in the next 5 years and the 5 years after. And then once you have an idea of what that is, you'll be able to make better decisions with your money. And we can walk you through that process. So as James was saying, the time frame is so important. Sticking to your guns and staying the line is so important. What your primary objectives are for your lump sum. So say we would have a lot of clients here that are coming up to retirement. You're getting a gratuity that you would have not be used to, or you wouldn't be used to managing assets like this. It is so important that you look at what you're going to use that asset for in retirement. Because I know, and I'll give my father as an example, my dad is approaching retirement, right? And he could kill me here because he could be on the call, right? But he has the same objectives for the next 5 years, which is go see Tipperary hurl whenever they're hurling. He wants to go see Munster play, which is tough at the moment. And he wants to go for his coffees. But his objectives in the short term, so the next 5 years, probably won't change for 5 years plus. But to do all of those things is probably going to get a lot more expensive. So he'll need his money that he's not using for the next 5 years to be working for him, so he can still do all those things that he wants to do.
That's a great way of looking at it, John. Can I just actually start? I meant to ask you a question there on the first one about how much you have available. So Deirdre in the local authority, she was asking what's the minimum I should be, I could invest or should invest.
It's a very good question. It's the first thing I'd recommend is to sit down with someone and have a look at what is appropriate for you.
Is it suitable first off?
Exactly. Is it suitable firstly is the main thing. Generally speaking, around 20 grand is the minimum investment that you'd be doing. But again, it can differ for a lot of people as to what the minimum should be, because it comes down to what their long-term and their medium-term needs are. So you might be taking I'll only put in this much approach, but you have to take into consideration, if I only put a small bit of what I have into a plan, the rest of that money is going to devalue, as James was showing us. So that's also the opportune cost of not putting that money away is so important.
Okay, but like I suppose we'll help them.
Exactly.
And James, I always love the idea of the buckets,
Yeah.
Brilliant.
Yeah.
I also had a question, sorry now. Jerry in the Department of Justice was wondering, can he have access? Can he have some of the money, as an income, or what way does it work?
Yeah, you can set up plans. So the plans that you can set up are very flexible, right? So you can set up a savings plan or an investment where you draw an income out of it every year. And again, people coming up to retirement, this can be quite important because your income has dropped so much. You may want access to this money in the next couple of years. So you can draw an income from it if you'd like to. And as well as that, Claire, a lot of these plans, you may be able to access them within the first 5 years, but it wouldn't be advised. These plans are really set up for people to leave your money and let it do its thing and stay its course for 5 years. But again, it can be done in emergency circumstances and stuff like that.
Very good. Thanks for great.
Okay. So look, we're going to send out an email to everybody, and just to remind you of the consultation process, if you want to sit down with myself or one of my colleagues to go through this kind of thing, we'll be going through the fact-finding process, we'll be identifying your goals, and we'll be going through the steps that I would have mentioned earlier on. If you do have any plans in place, I will go back to the regular reviews to make sure that we are touching base with you at least once a year to make sure that we don't need to make any changes and everything still suits you, because it really is important. We're going to send out an email, and there's going to be a link attached to that email for anybody who's I suppose anxious to maybe look at this in next couple of weeks. So once you get that email, you can fill in your details, and we'll ask you just a couple of questions, and then we'll get an advisor to ring you and organize a time where we can do a consultation with you. And we can do a consultation either by phone, by Zoom, or sometimes we can meet up with you. Okay?
And I think I know Sarah's there. Are we going to send a risk profile with the email, or what?
We are indeed, yeah. So the email you receive tomorrow will have a recording of the slides we've just gone through. As John mentioned, there'll be a link to request your financial review, but also we'll have a copy of the risk questionnaire that the guys mentioned earlier. So it'll be the 15 questions you can answer, and that'll give your advisor, a bit of prep work before your meeting. It'll give them a good idea of what your attitude to risk is. So that'll all be contained in the email you get tomorrow.
Great. I think there's a few other things that people would need to consider before making any decisions, John.
Absolutely, yeah. So the other considerations, and this part comes in very much at the recommendation side. So once we've gone through, I suppose, have an idea of where you're at financially at the moment and where you'd like to be, when we're making a recommendation as to maybe what plans we put in place, it's important to understand what, I suppose, allocation and fund management charges are associated with these type of plans to run them for you. Some funds come with an extra charge. Some funds justify it, and some funds don't. And that's our job as advisors, to give you guidance in that regard as to which ones would be worth having an extra annual management charge on it.
Okay.
There's also, you can make additional contributions to your plan. And as I said, you can encash the plans if you need to. We also advise you as well, as it's God forbid if anything was to happen to you while you have your money invested and put away, what happens on death? Okay, so the inheritance side of things, or who it will go to, and so on. There may be taxation implications. And then again, couldn't say this enough, the review of your plan every year is so important.
Great.
Okay.
That's great. So I think now, before we open the chat, we're going to open the chat functions there for the competition. Are we, for our voucher, the €100 voucher? See if they've been listening.
That's it. So I'm just going to open up the chat here now. And if everyone has the fingers at the ready.
So Sarah, the first person in here with the right answer.
First person with the correct answer.
Specific right answer.
Specific right answer. So it's an answer we've taken from the slides you've seen already. So you've already seen the answer. So as soon as you know the answer, you can pop it into the chat there for us. The press question is, by what percentage has the cost of milk increased since the last year?
Sarah's monitoring it in the background. She's very fair and she's very...
I try my best.
We're looking very too close, aren't we? Like, as in...
Yeah, an exact percentage. So I think we've a decimal point in there as well. So
I think we could see some people with very, very close answers. All right.
Yes, absolutely.
Some correct answers.
I've seen a right answer there. Yeah.
Yeah.
Brilliant. Yeah. Okay. So I will show the answer now. So 30.6% is the answer. So I think first one in there was Lee. So that's 30.6%. So well done, Lee. So you've won the €100 one for all voucher. So well done.
So we'll be in touch about that. James, John, are you happy enough if we could just 5 minutes take a couple of questions? Would that be okay if people want to?
Yeah, absolutely. Of course.
Yeah.
Okay, so everyone, you're welcome to pop a question into the chat function there. I'll leave it open and we can just see how many we can get through.
Yeah, Sarah, if you want to...
I'll keep an eye here, no problem at all, yeah.
Lee must come from a farmer background because he was honing in on the price of milk there. So well done, Lee.
Any questions, or everyone's gone home? Oh yeah.
Okay, so a question just around the Good Buddy funds. This is one for yourself, James. Just about what's the reason for the amount of cash in the funds if cash is losing value? You know, is there a reason why there would be a percentage in some of the Good Buddy funds?
That's a very good question, actually.
That's a very good question. And the reason we hold cash in the fund is that, for instance, sometimes, you know, for various reasons, somebody may have the fund in their pension and suddenly they go to, you know, cash in their pension. They put in a redemption request. So if we get a request in for, you know, a certain number of 100,000 out of the fund, we'll take it out of cash. So it's a very efficient way of getting money back to people as they may need it. But the other important thing is that, cash very much dampens the volatility or the risk within the fund. So if you think of different assets within the fund, they're moving around quite a bit. So what we're trying to do is lessen the amount of volatility, the movements within the fund, and cash does that for us.
That's great. Thanks for that. We have a couple here that I think would be relevant to yourself, John. So a couple of people asking, should they maybe pay off their mortgage or invest, or maybe is investing in a pension a good idea? So what would you feel there yourself?
Yeah, the mortgage versus investment argument is a very common one, and really it comes down to, I suppose, if you were to choose the investment option, what are you saving for? So is this an investment where you need money in 5 years, and is paying off a mortgage going to allow you to have money in that period of time? So again, when you ask the pension side of things as well, it all comes down to what your individual goals are, what you would like to see happen over the next number of years. So again, this would be different for everybody as to what would make sense for them. And that's why it's so important you sit down with an advisor, because we'll see where you're at the moment and where you'd like to be, and we'll give you recommendations and try and lead you on the right path.
It's not like a one size fits all, really. Sure, it's not.
Yeah. It's really case by case, isn't it?
Yeah.
Okay, perfect. And then we just had a question there. Is it possible to invest, say, monthly or regularly rather than making a lump sum investment?
Yeah, that's a brilliant question. It is. And you can invest in the likes of the Goodbodies fund or any of the other multi-asset funds on a regular basis as well. It's a different type of investment. So you're buying into these funds at different unit prices at different times. A very, very common one is clients would use their children's allowance or money that they're saving towards, let's say, particular college expenses that are 5, 10, 15 years down the line, and they need to get a return on that money. So they is the short answer to that. You can do a regular savings plan. Yeah.
Perfect.
And we have some people who might put, like, say, 20,000 in and then a certain amount monthly.
Yeah.
So you can mix and match, like.
Okay, great. I might just pick one more out here. James, you might answer this one for us. So Mary's just asking, is investment in property still worthwhile?
I think, what you need to consider there is part of an overall part of your investment. So, I think it's fair to say we would recommend generally to people is to diversify your investment mix. So, if you had a certain amount of money, I don't think it'd be a great idea putting it all into one particular property. And I think, when we often talk about property, there's different ways of looking at it. If you invest in an individual property, well, then there's certain amounts of risk around that property. So for instance, let's say you were going to buy a property in your local town, there was a shop unit. Well, you've got risk there that, the tenant in there, fails and doesn't pay their rent, and then you're left with paying back the mortgage. Maybe you might be looking at things like, on the residential side, obviously there's a lot of demand for investors at the moment, but there's tax implications there. And then there's the property funds. And I think the other critical thing with the property funds is to once again look in underneath the bonnet. What are these funds invested in? Where exactly are the properties? What's the mix of properties within a fund? Is it residential? Are they investing in retail outlets? Are they investing in hotels? These are the sorts of questions you need to ask yourself. So I think, there's a lot of questions you need to ask, but I think you need to take a more holistic view and just understand where it fits in within your overall, your overall wealth. And is it an appropriate investment to take given the risks associated with it?
Okay.
Yeah. And I think just on the last couple of questions, Sarah, I see a lot of should I do investment or do something else?
Yes,
and really what we do during the consultation process is we show you if you're to do one versus if you're to do the other and what the advantages and disadvantages are for each one. And then it's really we try and guide you as best we can, but it's ultimately up to yourselves as to which route you'd like to take. So we'll show you the pros and cons of each. And then it's up to yourself then as to which area you think would benefit you best. So it really is not a one or the other, is what I'm saying. It could be a balance of the two as well, as James was saying. So that's why it is important to just go through the consultation process. And if you take anything from it, it'll just give you a better sense of what's coming down the line.
Yeah. And I think it sounds just like the funds, John, that like diversification is your friend, doing a little bit of everything.
Yeah. Yeah,
and I think,
absolutely.
Claire and John, one thing I'd always say to anybody, you know, when you sit down with a financial advisor or anyone, you know, don't be afraid to ask questions. You know, if there's something you don't understand,
love questions.
you know, as I mentioned at the very beginning, you know, our industry loves jargon. We love making things as complicated as possible. So, you know, when you're sitting down, you know, with a financial advisor, you know, don't be afraid to, I don't understand that. Explain that to me again. What does this mean? Because, you know, it's important at the end of the day, it's your money. You've got to protect your money and get the best possible return for it. And it's only by asking those questions and taking control of it. So I definitely urge you, don't be afraid to say, no, I don't understand that. Talk me through that again. Very important.
Brilliant.
Yeah, absolutely.
I think that's great advice to finish up on, James. So look, thanks everybody for joining this evening. James Forbes, thank you very much from Goodbody. John, Irish Pensions and Finance, thank you very much. And Sarah, as always. And we will be in touch with everybody who joined the call this evening with the bits and pieces we promised them.
Thank you very much.
Thanks a million. Thank you.
Cheers. Have a nice evening. Bye now.
Bye.
Bye.